Hello, everyone, and welcome to today's Main Street Solar webinar. I'm Mary Alice West, Director of Marketing here at Atticus, and I'll be your moderator today. Before we get started, I've got a couple of housekeeping items to cover with you. First of all, if you have any technical difficulties during today's webinar, please don't hesitate to reach out via the Q&A button, and I'll be happy to reach out to you. Next, we are not going to be taking any Q&A at the end of today's event. Instead, if you'll go ahead and type it in as you have the question, I'll make sure that Drew and our private equity team get back to you at a later time. And then without further ado, I'm going to go ahead and turn today's programming over to Drew Adams. Drew, it's all yours.
Good afternoon, everyone, and happy Monday to everyone. Hope everybody had a nice weekend. I want to start out really quickly, kind of giving a high level. Some of you folks we may have spoken to, some we might not have, but Main Street Solar Fund was really developed to be a tax benefit focused fund. There are obviously economics that we'll be talking about through this presentation and certainly later. But at the end of the day, this is really about generating bottom line tax benefit or tax alpha for our investors. Meryl, so go to the next page. We started investing in solar a number of years ago, primarily with very high net worth families, high income families, and really doing it similar to the way large C corporations, institutions, Fortune 500 companies have been doing for years. You hear the politicians, talking about Fortune 500 companies don't pay any taxes, and that is because many of them invest into programs just like this. The problem with that for a lot of the folks that we talk to every day is they were kind of classed out of that market because it's a multi-million dollar investment, very bespoke, custom design type projects. They simply didn't have the level of tax liability. And we've always tried to figure out ways to bring things down to our audience that are more turnkey and give them a solution that has been typically reserved for much higher income corporations. So at the end of the day, as we're talking about this, you may start to find yourself thinking, well, how do I compare this to some other private equity investment that I might make or market-based securitized investment I might make? And the reality is that's probably the first things that we want to address with this audience is this is really not a choice between making an investment in multifamily or build for rent residential portfolios or public securities, things like that. These dollars are very special dollars. These dollars are reserved to go to the United States Treasury to pay your tax liability. So we're coming up on 9/15. People have estimates due. They're making, tax calculations. Their CPAs and advisors are making tax calculations saying this is how much you owe at this period in the year. This investment is meant to offset some or potentially all of that liability. We're to get into the types of income and who fits this program best, but at the end of the day, the decision here is to make an investment in a program like this or to pay your entire liability to the IRS. In this program, we're talking about why choose this versus just pay the bill to the IRS. Breland, I'm going to toss it to you on this next page.
All right. Thanks, Drew. Like you're talking about, we've sat there in the past and we've done all these projects with C Corps and high net worth individuals are big liquidity events that generated massive tax liabilities. But even in those, you had to sit there and you had to find specific projects that fit a specific amount of tax liability. And so what we did when we created our first fund last year was really look for those same type of projects, be it residential leases, community solar, utility scale type projects, where we could actually bring that partnership structure into play where we could allow the average Atticus client, family office client, that's the high net worth, high income earner, to be able to participate and not have to bring in a project that was specific to one income and have to work our way around doing it. So a lot of the projects that we look for are still that same community solar where we have a corporate off-taker. Like last year, we had one of the world's largest defense contractors in the state of Massachusetts as our off-takers. So, municipalities, A-rated corporate off-takers, or even getting into the residential solar programs, where those are backed by some of your nation's largest banks that are putting up lease structures and loans to get residential leases in place across a multiple area of communities. Especially if you think Florida has gotten really big into solar, whereas a lot of it's rooftop and the communities themselves are the off-takers as part of the HOA program, and they're highly incentivized to do so. So that's where we come in. We look for those specific type projects where we can really underwrite the off taker and really pay attention to who it is, and we can customize based on our purchase agreements. The way that we structure the debt, we have a lot more knowledge as who it is, how much it costs to build, and how we can turn it around to give the investors the returns that we're looking for. Like last year being $1.38 with the changes in depreciation. This year it's going to be more like $1.25 to $1.28.
Yeah, in our portfolio, one thing to take into consideration is we're going to be acquiring projects, already have those in queue. Lots of that stuff has been negotiated. Diligence is being conducted, but we are trying to build a diverse portfolio of projects that we will acquire just prior to placed in service. That's a very key term. That placed in service day is what generates the depreciation, the tax credits, and the other benefits. So we're going to be buying those and really de-risking these acquisitions because we're not taking construction risk. We're not buying just one type of project. We're buying a diverse type of projects in different geographies with different off takers. So this is a portfolio approach, but also gives this turnkey access that has not traditionally existed.
Correct.
Anything else? So getting into the return, which is I think what everyone cares about, we'll talk about in a moment who's eligible for this. Effectively, we are looking to generate $1.25 back on every dollar invested within the first 12 months. So I think if you kind of consider this from a other things I could do, obviously paying tax liabilities is a thing that you would have to do here versus do this. What we're effectively doing is giving everybody a 25% discount or 25% discount on their taxes. About 60 cents of that comes from the tax credits that are generated. We'll get into a little bit of the structure here in a moment. 60 cents comes from depreciation, then a small amount from the cash flow from the project. Most of the project's cash flow is going to go to service the debt. The reason that you're getting, 60 cents in tax credits is because for every dollar you're investing, we're investing another dollar of bank debt. So you're really getting the economics of $2 of investment, even though you're only investing $1. The same thing is true of the depreciation. But at the end of the day, and we'll talk a little bit about some of the back end potential returns. We're returning all of the money in the first 12 months plus a 25-cent return. And as you can see, very little of that return comes from the economic performance of the project. The main reason we want it to perform is to service the bank debt and have a successful project. Mary Alice? So on the who is really eligible, Bree, I'm going to ask you to speak to this for a moment as well. This unfortunately does not offset all income. We were hopeful that the Inflation Reduction Act would make the credits and other benefits from renewable energy projects offset non-passive income. Non-passive is in my own business. I work in this business every day. I generate, W-2 salary and K-1 pass-through taxable income. We were very hopeful that the credits and other benefits of renewable energy investing would offset that type of income. To quote someone pretty high up the IRS, they said, we didn't do this for the dentists and doctors. I think they made a mistake in doing that, but that is the current law of the land. So this is relegated to passive income. So passive income comes from activities that you do not necessarily participate in day to day. Most notably, these may be family businesses that you own stock in through mom and dad's own business, but you have your own business, so you don't operate in that family business every day. That would be a great example of passive income. Oil and gas income is a great example of passive income. Real estate lease income, where you've used up your depreciation and now you've got positive net income, would be examples. Bree, I don't know if you want to supplement that some.
I think one of the main ones that, Drew, you said, not for the doctors and the dentists, but there's a lot of doctors and dentists out there that own real estate, that own surgery centers, they own diagnostic centers, things like that are most likely spitting out passive income to those individuals. So when people are looking at it, and, especially in the last 4 to 5 years, and build for rent and multifamily has just taken over a lot of people's portfolios, and private equity offerings like that, that would be passive income. And so a lot of people, when they think about it, they just know that they have investments and they look at it as their portfolio, right? What you would need to do is actually back up for a minute and look at what's making up your portfolio. As you said, the stocks and marketable securities, not necessarily those are going to be your portfolio income, but those multifamily investments, the real estate, the the leaseholds, the equipment leasing, those things like that do generate passive income, and this works perfect for that.
Yeah, and there has been a big push, I would say, toward private equity investing. So a lot of folks have moved away from marketable securities and more into some of the illiquid assets. A lot of those private equity investments, alternative asset classes can throw up passive income. Anyway, so be mindful of that. The other thing is, I think people have in the last several years sold to private equity and may have rolled equity into those private equity platforms as part of the sale. So they got some cash and they were required to take stock in the new company. Oftentimes that may be passive income as well. So let's talk a little bit about the risks of investing in a project like this. So great, you give me $1 and I get back $1.25. That sounds phenomenal compared to paying my tax liability, assuming I've got the income to qualify. So what are the risks? So the first thing is there is recapture risk on the credits. The typical holding period for credits is 5 years, and that's certainly true of renewable energy. There are other credit programs that go longer than that, such as low-income housing. But this is a 5-year program, and it's got a declining scale. So in year one, if we were to have a recapture event, you would recapture 100% of the credits. After end of year one, it's 80, 60, 40, 20, 0. So at the end of the 5th year, there is no more potential recapture. So what are the things, and what is recapture? Basically, that means you would effectively have to pay back those credits depending on when that recapture event occurred. The things that can cause a recapture event are change of more than 20% ownership in the project, the project or projects blow away or burn up or otherwise destroyed by Mother Nature or some other act, or like a foreclosure on the bank debt. So those are the things that can occur. To talk a little bit about what do we do to mitigate those risks? Well, in terms of the project being somehow destroyed, we've got insurance. As long as we build it back in that 18-month period following the destruction event, we're fine. We've got business interruption insurance, continue to pay the debt and keep the whole portfolio intact and running. As far as foreclosure on the project, all of our debt instruments come with forbearance agreements. The bank has contractually agreed that they cannot foreclose on the project. They can step in and take control of the project to make sure that that they're protecting their interests, but they can't foreclose until after the end of that 5th year. So in every situation where there's a potential risk of recapture, we don't let people own more than anywhere near 20%. So we can't allow that because it could cause that issue. So everywhere there's a potential risk, we're closing and mitigating that risk. Breland, if you would speak to the debt for just a moment before we jump into the investor, talk about the risks associated with the debt and how we've mitigated those.
When it comes to the debt, the way that the debt is underwritten for the bank is just like everything else. They're going to look at the cash flow. And you spoke earlier that most of the cash flow goes to service the debt. And that's what the bank is looking at. So everything they do is based off the projections and the pro forma and the independent engineers report that this project and these panels can produce the amount of power that they say they can. There's weather studies, geographical studies that speak to how much sunlight's going to be produced. And so we feel comfortable with that regard, and so does the bank. However, there's other events. It may be cloudy, there may be snowstorms, there may be things that actually come into play. What we have in that instance is things like production insurance and guarantees from the O&M manufacturer that basically state, hey, as long as the sun was shining and these panels were able to produce power like they were supposed to the extent that they didn't, that production insurance would kick in and actually right side the ship to around 92 to 93 cents on the dollar, and in some cases even higher than that, so that even if the panels didn't perform the way they were supposed to, the cash flow would still come in as projected. And so really from the debt perspective on payment, that's it. And then also in everybody's world right now, interest rates are in flux and everybody's getting a little worried about what rates are going to be today, tomorrow, and 6 months from now. The way that we structure the debt is we make sure that debt is fixed for the 5 to 7 years that we plan on holding this project, so that we don't have any kind of an increase or an adjustment to that interest rate that could put the cash flow in jeopardy. That's something that's very important to us, especially in today's interest rate environment.
I think in every sense of the word, we've tried to be conservative and put mitigants and hedges in place to make certain that we are taking the least risk possible in this project. And quite candidly, even on the fixed rate, we're using a swap type contract to do that. Given where interest rates sit and with an inverted yield curve, we feel like that will probably be a mistake, but we simply cannot take the risk of having a non-performance. So it's a mistake we're willing to make because we can't have an interest rate increase that could jeopardize the project's cash flow and ability to service its debt. So in every sense of the word, we've been very, very conservative. I think when we talk about this $1.25 return, it likely will be better than that. I'll talk about that here in a minute. But we've tried to mitigate every risk we can possibly consider in this project, from everywhere, from the way we model it to the way we structure it, and so on.
And Drew, one of the things that you talked about the inverted yield curve, why I agree with that. That's also, we tie the swap contracts to at least to the recapture period. We're not planning on going anywhere for 5 years anyway, because we don't want to trigger the recapture of the credits. So that's why our rate's tied to that rate. It's not a rate that's going to extend well beyond that to where we could get affected by any kind of decrease in rates in the future.
And frankly, decreasing rates would be generally good, but for the swap contract, those would make
Correct.
it's way more valuable. We'll talk about that here in a minute. All right, Mary Alice, let's jump into the investor example. So this is an example looking at someone that has $1 million in non-passive income. So meaning from their business, from W-2, from their portfolio, could be some capital gain, but in this case, we're looking at ordinary income. And then $1 million in passive income from the family business, from oil and gas leases, from rents and royalties and things like that we talked about earlier. And so earlier we showed it in the context of, cents, 60 cents, 60 cents, and 5 cents. This kind of breaks it down into real dollars. So $2 million in income would dictate kind of a maximum investment of right around $280,000. We're rounding up a little bit. That delivers $167,000 in tax credits. Remember, tax credit is a dollar for dollar offset to tax liability, so it has a $1 value. And then the depreciation benefit. So again, depreciation is actually a much larger figure, and then we're factoring that at about a 41.5% rate, which is a good average rate coast to coast. There are some jurisdictions that are higher. There are some states that don't have state income tax, but generally speaking, we've used about a 4.5% state income tax rate. So as you can see, the vast majority of the benefits comes directly from the tax benefits, very little from cash flow, but the cash flow is still a meaningful item. And so year one benefits is right around $70,000. And what you're going to see here in a minute is it kind of eats up from that 125 return up a little bit higher than that, and then it'll kind of return. So the total net benefits at the end of the project, the life that we're projecting is 7 years. It's about $71,000. So that's how we get to that $1.25 return, is dividing that 70,000 into the investment of 278,000. Let's go to the next page, Mary Alice. I want to walk through this on a year-over-year basis. So if you look at it in 2023 projected, we make this $278,000 investment, as I just went through. We've got the benefits that we talked about. We ended up netting out right at that $70,000 figure. And then we end up with some cash flow and depreciation year over year. So if you see through 2024, we're adding quite a bit. 2025, we're adding quite a bit year over year. 2026, it slows down. 2027, it slows down a little bit more. And then 2028, it really ends up really kind of turning negative because of the tax benefits and the cash flow associated with those ends up turning negative. And in 2030, you see a little bit bigger negative number. The reason for that is, again, us being very conservative in how we model this, is we're assuming we're selling the project in 2030, which is a 7-year holding period. And because we are allocating 100% of those sale proceeds, assuming that every dollar is a recapture tax event, meaning when you sell depreciated equipment or depreciated buildings, some of the sale proceeds are ordinary income for tax purposes. So instead of 20% capital gains rate, we have a 37% federal income tax, right? That is what we're assuming in 2030. And that's why we're getting cash, we're paying off the debt, but we end up with this big tax hit because of it. And so we end up, with a bit of a bell curve. We start out at 70,000 ahead. We peak out at $94,000 ahead. We end up back at that $70,000 ahead, which is why we tell folks it's just much simpler to say it's a $1.25 return versus getting to some of the machinations. The one thing I think this is probably one of the key things that I want you to take away from this discussion. Going back to what we said earlier, we have modeled this incredibly conservatively. And one of the most notable places to talk about where we've modeled it very conservatively is what is the value of this portfolio of solar assets at the end of the 5 to 7 year period. Our most likely buyers are banks, large institutional wealth management firms, or insurance companies. They view renewable energy as a great fixed income asset. They view it as satisfying some of their, self-imposed ESG mandates. So they are the likely buyers for these portfolios. Today, these types of portfolios are trading at about a 6.5 cap rate. They don't really trade on cap rate, but if you translate it, that's about right. We are modeling an exit of this portfolio in between a 9.5 to 10% cap rate. So in other words, we are expecting a massive decline in value from where we acquired it because of the credits. We've used those up at the point we sell it in 5 to 7 years. Nobody else gets credits. We already use those. So we're expecting a major value loss at the end of that 7 year period that may or may not be realistic. As we talked about earlier, if rates do in fact go down, we may stay at that 6.5. We could even get down into the mid to low 5s, which is where it was about 12 to 18 months ago. If that happens, we could have some pretty nice dollars on the back end. So I think the way that we would encourage folks to think about this is you're making an investment with someone else's dollars, the United States Treasury's dollars. You owe those monies in tax. You're going to pay them if you do nothing. Conversely, we put it into this program, you get 25 cents of that tax dollar back. So you're already in the money. And there's a pretty decent chance that you may come out of the back end with a nice return as well. We just don't want to promise or guarantee that. But the reality is you're playing with house money when it comes to that back end potential return. So anyway, I want to make that point. Anything else? Really, we want to kind of go over the fund itself and the target audience.
As far as the fund itself, it's as we pointed out through, it is for people with passive income. Typically, like you see on the screen here, having passive income in the neighborhood of 250,000 and up. Fund itself will have multiple projects across it, anywhere from 7 to 10 projects, just depending on size. Geographically, anywhere from the Northeast out to the West Coast, the Southeast, and even the Midwest. When it comes to the life of those projects, typically we model them out for 5 to 7 years. They have contractual cash flow from 20 to 25 years. So to the extent that we actually decided, like Drew said, if rates go back to where they were a couple years ago, we could actually refinance the projects ourselves and keep it as a cash flowing asset that would generate about a 13 to 15% cash flow return for us after that point. So that option is available for us to do that. But as far as Drew, I think the minimum investment for the fund, I think the PPM has it as 100,000. Is that correct?
Yeah, that's right. And we would probably waive that down to a $50,000 investment this first year. So as the manager, we can do that. And we're more than happy to do that. At the end of the day, this is our year of education, building the network of contacts, and let people check this out, see how this is going to work. One thing I did fail to mention, I think is a very important thing, is that these credits are eligible for a carryback, meaning I can offset the 2023 liability, and any unused credits I can carry all the way back to 2020. I can request a claim for refund. I can carry those to 2021, request a claim for refund, carry them for 2022, and request a claim for refund. So for people who have passive income in the past, or even potentially passive capital gains in the past, we can utilize those credits to go back and get some of those dollars back. So we can work with you in modeling that and analyzing that situation, working with your advisors to help you figure those things out, figure out what the right investment amount is, the investment right for you. How does it apply? What should I expect from a return point of view? This could be a very nice overall benefit for 2023 and really the previous year as well. The other thing I'll point out, I get this question a lot, is in carrying that credit back, does that necessarily open me up to like an extended audit timeline? And the answer is it does not. So Sometimes there's trepidation about carrying something back or opening up a return in the past. That's not going to affect your statute of limitations on that return. So I hope this has been helpful today. We had an abbreviated session where we weren't able to do Q&A. I apologize about that, Mary Alice. I don't know if we got any questions, but if we did not, this is our team. There's a whole website set up. If you go to atticusadvisors.com, there's a Main Street Solar tab on there. It will take you through a great educational experience. If you want to go deeper, there's a private website that walks you through the process of how to get into that private website. There are some steps that you would need to take. More than happy to have one-on-one discussions, get into the modeling, review returns. We want this to be very educational and advisory from our point of view, and we're here to assist. Thanks everyone for your time today.
Thank you.